Hello, and welcome to this latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Jeffrey Rosenberg. Jeff is a Managing Director and Senior Portfolio Manager on several portfolios, including BlackRock's Systematic Multi-Strategy Fund. He also serves on several executive committees. Jeff, welcome.
Thanks, Marianne. Great to be here with you.
Oh, it's so wonderful to have you. You're a dear old friend from our old days at Bank of America.
Yes, indeed.
And if you don't mind, I'm going to brag about you a little bit.
Oh, now I might.
Back in 2008 and 2009, you kept writing about what was happening in the financial industry. I think you also wrote that you might even put yourself out of a job by writing what you were writing about. And you were 100% correct about what was happening within the banking system. And I want to congratulate you for that.
Well, thank you very much, Marianne. But I recall sitting with you on a March 2009 with a very good call at 666 on the S&P, calling it a big buy. And I remember looking at you and saying, that seems like an ominous number to go long, but that was a very good call by you at that time.
Well, thank you. Thank you. Thank you. I appreciate that. We really do appreciate you joining the podcast.
Great to be here.
I loved the title of your year ahead report. You said, meet the new bond, same as the old bond. What did you mean by that?
Well, it's 2024 and we're repeating the bonds are back narrative again. We did it again. We did it in 2023. We pushed back on that in 2023, saying it was a little premature, and we were correct. 2024, we're more enthusiastic about the bonds are back narrative, but we're nuanced in what we mean when we talk about what's back. What's really back, and what I meant in like meet the new bond, same as the old bond, is there's only one thing that's really back when it comes to fixed income, and that's yield is back. So we actually pivoted our title at the beginning of last year as yields are back. This year, it's about what's not back when we're talking about bonds are back. So you think about the old fixed income environment. What was it that made it so great? Well, you had yields above the level of inflation. So that check, that's the thing that's back. But you also had reliable diversification against stocks. That's a little bit more back than last couple of years, certainly, but there's still some uncertainty about that. And the last aspect is that the old fixed income market was one where you were rewarded for going out the yield curve because the yield curve was positively sloped. And a big difference and a really important implication this year is that the yield curve is historically inverted. So you get penalized in terms of yield for going out the yield curve. And the best yields are still to be found in the shortest maturities on the yield curve. So there's a lot of differences in this fixed income market. We'll elaborate on that during this podcast, I'm sure, but you want to be just a little bit careful about the simple narrative. Bonds are back because yields are high, and I could just go do the same things that I did in my fixed income market for 20 years prior to COVID.
Well, obviously, inflation is an important topic. We really haven't talked about inflation for many, many decades. And we recently had the new PCE, or the price consumption expenditure, PCE, out by the Fed, which apparently is one of their favorite measures of inflation. And when you look on a year-to-year basis, it's consecutively down 12 months in a row. We're back at a 2 handle, not 2%, 2.8, I believe, was around the last number. That could get revised. What's your outlook for inflation? Is inflation really coming down to the point where you think eventually the Fed will be able to cut rates?
So your premise to the question was we used to not talk about inflation at all. That was like in the 20-year pre-COVID period when inflation was just bouncing around and was below 2%. Not only was it bouncing around at a low level, but it was actually too low. We'll come back to that perhaps. But COVID obviously brought about a period where inflation was the only thing that mattered. And I would argue that we characterized last year where the predominant driver of macro market directions, both stocks and bonds, was inflation and the uncertainty around inflation. I'd argue that 2024's outlook is more about inflation certainty than uncertainty, meaning the certainty which we all hold, meaning the market consensus economics forecast, that inflation will reach its 2% Fed objective, or the Fed will attain its 2% objective. And there's great confidence in that. And partly why there's confidence was up until that January number, there's lots of different ways to slice the inflation data. There's different ways to annualize the data, to look at it. You were giving year-over-year comparisons. The market follows the Fed's lead, and the Fed started talking a lot about 6 months. So take the last 6 months of inflation data and then annualize that. And that's telling us where the more near-term data is pointing to the direction. Eventually, that year-over-year number will catch up to that. 6 month, month-over-month annualized inflation was at the 2% target on core PCE, which everybody got very excited about in December. The Fed gave itself a pat on the back, did a victory lap, started talking very strongly about their confidence that they had attained their objective. And what did the bond market go ahead and do with that information? It said, oh, this Fed's about to cut interest rates. It priced in 7 or 8 cuts. Now, since then, the January number was a little bit of cold water on that. The Fed has changed its narrative and pushed back and said, hey, what's the rush? So we're pushing back on those expectations. But the bottom line here is inflation. Fed's done a pretty good job. With that, the Fed can start cutting interest rates, but not as much as the bond market was initially expecting. So we're kind of pulled back. The bond market's finally come around to our view. You're going to get some cuts. They're going to be later in the year. And if you start later in the year, there's not enough meetings to cut, and they're not going to cut super aggressively and throw a 50 in there. So it's probably 3 cuts at 25 and 75 basis points beginning June is my current estimate.
So, Jeff, the economic world that you and I grew up in, if the Fed went from 0 to 5.25 in less than a year, I think those models would have signaled, just looking at rates alone, would have signaled a recession.
And they did.
And they did.
The model signaled.
Right. And we have had unprecedented liquidity from the Fed and from the government. In my humble opinion, I don't think there's any model around that has anything like that in it. We're trying to figure this all out. So we didn't have a recession last year. It looks like economic growth is actually turning, that it's troughed and that we might grow. And you know, I'm an equity chick. I love the stock market. And the stock market is telling me things are going really well. And it looks, because I've got cyclical industries moving. Not only do I have the S&P breaking out at all-time highs, the NASDAQ breaking out at all-time highs, global markets are breaking out. I've got Japan breaking out. I've got Europe breaking out. Can you kind of talk about U.S. growth, and if you're comfortable talking about global growth, what we should maybe start thinking about in 2024?
Yeah, so I will echo your enthusiasm, the bullishness, and the kind of disconnect that we saw last year between the interest rate expectations around recession from the yield curve inversion. It was the false signal. It was the signal that drove many forecasters and consensus into last year into recession prediction, because the yield curve has been a pretty good predictor. And it makes sense. If the Fed was going to create that large of an interest rate shock, historically, you'd get kind of slowdown leading into overheating, killing the overheating leading into recession. We didn't get that this time. There's a lot of reasons for that. You pointed to one of them. Liquidity is one of it. The other big reason is that the Fed signaled this move for a long period of time in the form of a protracted period of low interest rates, and people took advantage of those low interest rates. And so there's a little bit less vulnerability in terms of interest rate sensitivity in consumers and corporate balance sheets. It's different depending on the type of corporate that you're talking about. You see this in kind of Russell 2000 companies versus kind of the larger cap companies in terms of their interest rate sensitivity. But overall, companies don't have as much interest rate sensitivity. Consumers don't have as much interest rate sensitivity. So it's really helped in terms of the economic growth side. So let's flip to your question, which is, basically, the one thing we may have to consider is what I call too much of a good thing, that the vulnerability in the outlook, if there is one, to this kind of boomy growth feeding, earnings feeding equity valuations that you were talking about globally, is that the one little wrinkle in there is we still have the market also expecting the Fed to support that in the form of lower interest rates. And you asked globally, it's not just a U.S. picture. The ECB is expected to cut interest rates. Emerging market central banks are already cutting interest rates. We got some news today around the policy supports from China, and you're seeing, some turn in the Chinese markets. So a lot of policy support expectation globally. What might trip that up is that it might be too strong of growth, signaling that the Fed, something it has great confidence in, that it's highly restrictive, may not be as restrictive as it thinks. And that will kind of sap the Fed of some of its mojo on, hey, we need to get around to cutting interest rates. It's not a horrible scenario. It's probably more of a fixed income concern than it is an equity concern. But where you have equities that are highly sensitive to the denominator effect, right, more than being powered by changes in earnings, they're very sensitive to changes in interest rates. You may have some equity consequences of that if you had that scenario. I'm not saying that's the baseline scenario. I already said my baseline scenario is 3 cuts. But we have to watch this growth trajectory because it's very positive. But the thing I'd be a little bit concerned about is that if it stays higher than trend for longer, right, the Fed's expectation, the consensus expectation is that we get a slowing in that growth.
Chris, in first quarter, I think right now, the GDP now, Atlanta GDP now is 3%, but consensus seems to be below that.
Much below that. And so that GDP now has been a better forecaster than the consensus forecasts. And so watching that has been a very good signal. But yes, the consensus is coming down because what they're looking at is this temporary boost from the supply side aspects that they don't see kind of being sustainable. But they've been surprised and they've been wrong. We saw it in the third quarter last year. We saw it in the fourth quarter. We're already seeing it again in the first quarter. So the theme that emerges there is, well, maybe the bearishness in terms of the decline in growth is overstated again. Good news from the numerator side, revenues, earnings. Little bit worried, though. We got to be careful about what it does on the interest rate sensitive sectors and in fixed income markets, what it does to interest rates.
So it's not really a curveball question for you. Is there any probability you would put on that the Fed doesn't cut rates and or raises rates?
Yeah, I mean, that's the scenario that I just talked about.
I'm just trying to get you to say that.
Well, and it's, I mean, the point is it's not zero. It's not 50%, it's maybe 10 to 20%.
And something to watch.
Yeah, and you watch that Atlanta Fed GDP, you watch the confidence figures, you watch the spending figures, and most recently, you watch this inventory cycle and kind of a little bit of the uptick that we're seeing in the manufacturing cycle. Generally, we think of that as kind of good news. Manufacturing cycle, obviously highly distorted coming off of the boom bust in terms of COVID. But if we're kind of past the COVID cycle and we're getting back into some kind of normal cycle and we see the manufacturing cycle start to expand, that leads into this too much of a good thing scenario that we got to potentially keep an eye on. That's the probability of maybe no cuts.
So the fixed income market is probably very keen on watching economic data.
Oh, it always
is what I would take.
And it always is. And it's really about the economic data relative to its expectations. So you don't need a huge move in the economic data. It's just the economic surprise relative to what's priced in it. And the problem there is what's priced in is, again, that confidence in inflation going down. The growth picture, by the way, on the inflation side is like, if you're not growing, ultimately long-term, what's the driver of inflation is whether you're growing too fast or too slow. If you're growing too fast, it pushes up on inflation. So the growth, too much of a good thing, kind of feeds back into the inflation narrative as well.
The other important economic factor we haven't talked about is employment. And what's your outlook? And then if you can dive into everything that we just talked about, how do you take all of this and factor this into your systematic models in your funds?
Yeah.
You can tie it up in a little bow.
So let me talk about the ideas, and then I'll talk about the process in terms of tying it up in a bow. So first of all, labor markets in the picture, very strong. Expectation for normalization of labor markets that has been disappointed on the good side from a kind of positive economic growth perspective, but again, too much of a good thing. The labor markets are not slowing as fast as had been anticipated. There's been surprising strength. Unemployment rates, as sort of a measure of that, have not been rising as fast as the Fed had been predicting. And you're seeing a slowdown in wage growth. And let me just say it's kind of ambiguous exactly where that wage picture factor, where it settles in. There's different cuts of it. There's lots of different measurements. A lot of people will focus on average hourly earnings. I look much more at Atlanta Fed Wage Tracker and Employment Cost Index. In January, we got the tick down in Employment Cost Index. It's a quarterly figure. It's very slow. It's more signal, less noise. AHE, by the way, each month, more noise, less signal. I tend to downweight it. Which is also kind of goes back into the tying it into a bow in the models. But the wage picture is a little bit concerning, and it's related to the strength of the labor markets. The longer those labor markets stay strong, the longer the slowdown to that sustainable 2% consistent inflation rate of wage growth, which most people think is about 3.5%, remains the picture. And that's directly feeding into services inflation. And so that inflation...
And that's where most of the inflation is popping up right now, correct?
That's right. And that's where most of the kind of long-term sort of the signal on inflation, as opposed to the noise of the COVID distortions. Once we take out the noise of the COVID distortions, the long-run trajectory of inflation is going to be driven by wages and wage inflation through the services component. That's going to be a much bigger factor on inflation. And so that's the one also that we kind of keep an eye on, because it's, again, relative to market consensus expectations, that's the one that could trip things up. So far, it's a slow trend and it's moving in the right direction, but it's kind of flatlining a bit and a bit above that 3.5%. So we got to watch that. Tying it into a bow, all of these ideas, all this conversation that we're having, our way of doing systematic investing is to take those ideas, the sensibility behind each one of them, and implement them into portfolios in a systematic fashion. How we do that is we take, say, an indicator like wage inflation, and we turn it into what we call a signal. All that does is it kind of turns it into a normalized time series score that we can use and compare it across time, across regions, consistently, and we can use it as an input into our overall investment process that looks at inputs, signals, forecasts for returns, risk models to penalize those returns, transactions costs, and optimizes portfolios based on all those pieces of information. And that's kind of a very quick, rough sketch of what it means to be systematic.
So I'm going to use my language. I call that quantitative, right? So if it's another way to explain it is that you're taking all of these models, you're determining what are the appropriate weights, probably based on how good the information signal is, and then picking what asset class that you like, and then weighting in a portfolio. Is that correct?
Yeah, it's a
I'm trying to do it nice.
description.
I'm trying to put it in retail language.
Yeah.
Okay. So the last time that you and I had a conversation, we were in the middle of a banking crisis again, right? We had the regional banking crisis. Markets responded negatively, but wound up coming back because the Fed came in right away and fixed it, and obviously printed more money, more liquidity. And here we are again. There's another bank out there that seems to be under stress. There's been a lot of concern about commercial real estate negatively impacting some banks. Are you seeing anything in your models that are concerning you, especially given your expertise from 0809?
Yeah.
Are you seeing anything that's possibly negative that's concerning you?
Yeah, it's funny because it is sort of echoes of that 0809 banking crisis. And there are a couple of really key lessons from that period, and really a study of any banking crisis that should be learned and then applied. And the big lesson is that, banking crises are about solvency and they're about liquidity. And usually it's a solvency concern that sparks a liquidity crisis that sparks the banking crisis, a run on the bank, and that ultimately forces some kind of reconciliation. And policy intervention, in SVB case, as well as back in the GFC, policy can solve a liquidity crisis, but it can't solve the ultimate source of that crisis, which is solvency. So to bring it down more to retail language, what we're really talking about when we talk about solvencies, we're talking about the value of the assets versus the value of the liabilities, right? The liabilities, the value doesn't change very much. Those are the deposits. And the assets are the loans that they have on the balance sheet, the mortgage loans, the commercial real estate. Those change. And when there's a gap between those assets and those liabilities, policy can help to bridge that gap by providing a liquidity bridge. And a liquidity bridge is basically extend and pretend. So let's buy time for the assets to recover in value so that the company, in this case a bank, doesn't have to go insolvent overnight. So SVB and the kind of solution was basically that issue, because the assets that lost value, they lost value in a mark-to-market sense. They had a duration mismatch. And so if they had to mark-to-market that gap in their balance sheet overnight, there would be a huge systemic crisis. The Fed came in and basically said, we'll loan against your treasuries that have dropped in value because we took interest rates from 0 to 5%. You took a little bit too much duration risk, Mr. Banker, and that was a mistake, but we'll loan you against the full face value of the treasuries. That was a policy innovation, like all the policy innovations during 2008. And it's remarkable how policy innovations can solve problems.
And that loan availability is still out there, if I'm correct, right?
Yeah. And the key is that you loaned against the full face amount, even if the market value was 60 cents on the dollar. And that kind of solved the problem. In NYCB, it's illustrative of a different issue, right? When you have solvency issues related to assets that are linked to buildings that are empty because they're Class B, Class C, and this may not be NYCB's particular issue because I don't think it's commercial real estate as much as it is kind of New York City co-op. But when you have those issues, you can't solve that with a liquidity bridge. Those issues have to be solved with capitalization. Now, they can be ameliorated with time so that you give banks time to earn that capital base back and not have to mark to market. And that's the broad issue. You asked, what do we see in the financial sector? You see commercial real estate and this big shock of COVID that has fundamentally transformed how we work and the value of commercial office space around the country, around the world. And that is a long-term transition. And the way in which we are going to try to work through that transition is to have enough time to work out those loans and not have to PV all of those losses on those balance sheets today. In vehicles and structures where you end up doing that, you take some big losses. And we've seen some of that. In vehicles where you have more time to work out, you build capital to take the offsets in terms of the losses. It's a hit. It's a hit to equities, or the equity value of the equity owners, but it's survivable. And it's not the systemic risk of what we dealt with in 2008.
And my understanding is, especially for the major banks, commercial real estate loans are a very small percentage of their book. Plus, they have a lot of loan loss reserves.
Correct. This is not a large bank. It's more regional and smaller bank issues. And so that's an equity issue, but generally that equity is privately held. And for those individuals, it's going to be an issue. But for the broader market, because those exposures are not widely dispersed, it's not an issue. So
nothing like 2008 and 2009.
No.
Not even close.
No.
Now, the Fed invented quantitative easing, printing money. Now, the Fed has always printed money. Now we have a big fancy term. And they found, during 2008 and 2009, they printed money. But when they really printed money was during COVID. And their balance sheet went up to $9 trillion. I almost had a heart attack when I saw it at $9 trillion. And, I understand monetary policy. And I'm like, that's a lot of money. It sounds like a lot of money. Well, it really is a lot of money. The Fed now, as they've been raising rates, they're trying to take that portfolio that grew to $9 trillion down, which is what they call quantitative tightening. Now, they're recently talking about slowing that process down,
which we call quantitative tightening tapering.
There you go.
QTT.
Do you use the Fed's balance sheet in any of your models? Is there any predictive value in what the Fed is doing? Because it's relatively new.
Yeah, it's relatively new. I would say it's good in a descriptive sense. Like if you run models on assets that are highly Fed QE sensitive, like the mortgage market, it's the plug data that like makes everything work. It's the missing variable that if you use historical variables that don't include the Fed's balance sheet, you get a lot of errors, you get a lot of residuals, and the residuals go away when you kind of magically find the data that exists, which is the Fed's balance sheet. The tricky part of doing that is it's a little bit of what we call peek ahead bias. Like, you know that the Fed's balance sheet is important, and so you put it back. It's hard to run those on a go forward basis. Nevertheless, the Fed's balance sheet is a hugely impactful area across fixed income markets, global markets, for the reasons that you said, and where they own and how they own has measurable impacts, particularly mortgages, particularly long-term interest rates, particularly the term premium. That's where you see a lot of these impacts.
So I'm a big model fan. Obviously, most of my models that I've built through the years are in the equity market. What are some of your favorite models that you're using today in your systematic process?
Yeah, so we use a lot of different types of models in investing in systematic multi-strategy fund, the fund that I run. And my favorite models are a different type of approach when thinking about extracting returns. You know, so much of what we're talking about are the big picture things, the direction of markets, interest rate models, equity valuation models. Those are super important. But one of the things I like most about what we do is a very different kind of investing. And it's an investing that's focused on neutralizing and taking out of the conversation almost everything that we've just talked about. Get rid of the big picture, get rid of the directional view, get rid of the beta, the market, the factor exposure, and get in between markets, get inside the markets for the idiosyncratic risk. And when you start trading on idiosyncratic risk, what you're extracting from markets is a really, really valuable form of return, which is alpha. And alpha, what we call pure alpha, is returns sourced from pure idiosyncratic risk. And while you know me as the fixed income person, well, we grow and we evolve. We actually run a long-short equity strategy inside of my fund. Now, what's interesting about it is it's long-short equity that grew up out of a fixed income investor's perspective. We do long-short credit, and then we turn our long-short credit models and we apply them onto the equities of companies that issue debt.
I have to say this. As an equity person, what I learned during 2008 and 2009 is in many ways, there's a lot of information in the fixed income market before it gets to the equity market. And it does influence the equity market.
And
is that kind of some of the things that you might be looking at?
That is exactly it. And go back even more to that experience, and you'll know that there are certain times in equity markets where that fixed income lens, that fixed income perspective takes on greater attention and importance to the typical equity investor. And then there are other times when it doesn't. And that time dependency is highly related to what's going on in the direction of markets, right? When things are really great, people are focused on the sky, the moonshot, the equity income statement. But when things are tough and you're worried about recession and cash flows or COVID, now you start worrying about, what's that balance sheet look like? What's my liquidity? Where am I going to get cost of funding? And it's this notion that equity investor attention shifts to the fixed income lens when things get tough, creates a very particular characteristic to our alpha, which we call defensive alpha, which is our alphas, which are not directional, but they take on a very strong defensive characteristic, meaning the strongest alpha returns occur in tough equity markets. And what it creates, Marianne, and why we do it, is it creates a fixed income substitute. It creates a different way of adding ballast into your portfolio, away from having to rely just on duration, which is was the most reliable negatively correlated stock instrument. We lost that correlation in the inflation period, maybe getting it back a bit now. But this is a really nice complement to that. And it's some of our most successful ways of implementing systematic investing. And they're the most differentiated, the most interesting. That's my answer.
I can see you're very passionate about
Yes.
it. You're getting very excited about it. One other area we haven't talked about is housing.
Yeah.
right? My belief is that we have a shortage of housing, but the data supports that, right? We had a shortage of housing before COVID. We increased that. There's not enough housing for millennials. More than 50% of the millennials are still living at home. But we've been in this higher interest rate environment. Mortgages have been like 7 or 8%. But it doesn't seem to really, on a national basis, be negatively impacting housing. So what are your thoughts about the housing market?
Well, it's so interesting, right? Because back to the '08 period, obviously housing was a huge component. And when you go back to that pre-GFC, the pre-'08 environment, we talked a lot about residential construction and the boom in residential construction that was being fueled by the mortgage bubble at the time that was brewing and how important it was to economic growth. So compare that to today's environment, and you have something really unexpected going on. It makes a lot of sense now that we know it's happening, but if you had to predict it ahead of time, you might not have guessed that the most interest rate sensitive sector, after a 500 basis point or more increase in interest rates, would be kind of booming in terms of the economic impact. And this is where we have to separate two really important issues when it comes to housing. One is existing home sales, and the other is new home sales. Existing home sales is super important to people who have homes, people who are moving, to the realtors, to the mortgage bankers, but it's kind of irrelevant when it comes to economic growth because an existing home exists. It's the new homes that create economic activity, construction. It's not that existing homes doesn't do anything because there's movement and there's upgrades and there's new furniture and the like, but it's small relative to the economic impact of new home construction. And so what has happened with the interest rate spike? The lock-in effect. The existing home sales market froze because no one wants to trade out of their 2% mortgage. And so all housing activity, the only opportunity for it is in the new home market. And so you've had a lot of activity move into the new home market, which has actually supported construction and supported real estate. It goes back to this notion we started talking about earlier about, hey, where was the recession? Well, usually your interest rate sensitive sectors are slowing your economy when you raise interest rates 500 basis points.
Well, manufacturing slowed down. Now, back in the 70s and the 80s, manufacturing was much bigger component of the economy. It's much smaller now.
Yeah.
We're not as interest rate sensitive.
We're not as interest rate sensitive. And the housing interest rate sensitivity, kind of because of this lock-in effect, worked in the opposite direction. And we kind of are supporting it. So you'll get some more existing home sales with a reduction in interest rates. I think you'll take all that kind of built up demand that is from partly still the COVID effect, partly from being locked out of just affordability. And it's quite supportive of economic activity. And then a little bit, back to my story about careful, too much of a good thing. Fed starts cutting interest rates, market starts anticipating it, housing starts to boom even more. And it's a little bit more stimulus than maybe what the Fed had signed up for. And we got to be a little bit watchful about that.
Does the consumer fit in anywhere in your work?
Of course. I mean, how could it not? Because right? The consumer, you said it a minute ago, we used 70s, 80s, used to be a lot more manufacturing. This is a service-based, consumption-based economy. So consumption and the outlook for the consumer is the driver of the economic forecast. And again, a lot of the forecasts got it wrong because they were expecting a bigger hit to the consumer from the drawdown in kind of the accumulated wealth, the accumulated liquidity from the kind of government payments. Consumers have continued to draw down on savings. And so there's a wealth of savings. There's a confidence to draw down on savings, and that's all supporting consumption. And the biggest thing is real income growth. So as inflation's come down, and it's come down faster than the inflation has come down, there's a makeup on the negative real wages that consumers suffered during COVID. The government kind of plugged a little bit of that hole with the transfer payments. Wealth and wealth reflation helped on the confidence side. Now you're getting further support on the consumption side from the rise in real wages and the expansion of employment. And so you look at kind of aggregate consumer income, which is kind of wages times jobs times hours. That's really quite supportive of the consumption outlook.
And if you own a home, the value of your home is up. And then so the whole net worth of the consumer is at a record all-time high.
And to bring it back to our favorite acronym from that pre-'08 period, MU is coming back, mortgage equity withdrawal. So not only is your wealth increasing, but you're starting to see more people go back to something we did in that pre-crisis environment. Now, we went to a crazy level back then. We're talking about going from like zero to like a modest amount, but you're seeing people actually tap that wealth, not just for confidence, but turning it back into an ATM that you can liquefy that wealth.
More liquidity. What are some of your attractive investments right now? I'll leave it open because you're doing fixed income, equities. What are some of the things you like right now?
Yeah. So I mentioned it before. I mean, we're still in this historic inverted yield curve where you're penalized for going out the yield curve in terms of yield levels. But I also think that the value of the very back end of the market in a portfolio construct space is also less attractive than it once was. That kind of first question, meet the new bond, same as the old bond. The old bond, you wanted to own the back end of the curve. I think today it's much more attractive in the front end. Now, there are some practical considerations when thinking about duration and yield curve exposure that depend on your particular portfolio construction constraints. So I'm a complete liquid alternatives, flexible investor. I can use futures. I can use interest rate swaps. I'm not bound by 100% portfolio characteristic that, say, a model investor might be if they're allocating according to a model. So when I say I like the front end of the yield curve for duration exposure, that works because I can use a bit of leverage to effectuate that exposure and not limit my overall portfolio allocation. If I'm limited to 100% allocation and I want to own all my duration in the 2-year, there's going to be nothing left to buy NVIDIA and the MAG, I guess they're now the MAG 5 stocks.
I've heard Fab 4, so
right.
It just keeps changing.
Right. I guess Google was down today, so now it's the Fab 4. We're going to have to watch that. That's another conversation, your world on the narrowing of the market. But in fixed income, that front end of the curve exposure is very attractive. You just want to be able to access it with a flexible approach that allows you to use leverage to take advantage of that. You got to be careful about the kind of knee-jerk reaction I've seen in the marketplace with flows. You saw it big last year, the flows into our TLT. It's the long-dated ETF. People love duration. Fed's cutting interest rates. Well, and I'm going to buy the longest duration product out there. I only need a little bit of it, so I don't have to occupy a lot of my portfolio, freeing up a lot of room in my portfolio to buy other stuff. The one thing we got to be a little bit careful about is it's a very inverted yield curve, and there are some really different structural dynamics going on. One I'll just highlight, which is the obvious one. Our deficits are in a completely different zip code. So when you think back to that old bond market, it was also supported by 2% deficits. And in the 90s, there were zero or surpluses. That was really positive to yield curves, bond performance, 2% deficits. Now we're talking about 6, 8, 10% type deficits. From here on out, those have to be funded and go back to quantitative tightening, no longer quantitative easing, no longer you're going to have central banks absorbing that extra amount of issuance. That's going to have to be absorbed by you and me. And the premium that we're getting for doing that, very unattractive from a historical basis. So you could see something very interesting happen as the Fed starts cutting interest rates. Generally, you expect the yield curve to steepen when the Fed cuts interest rates. That's kind of textbook. But you could see what I call the twist steepening, where the Fed's lowering interest rates, but because you have so much of this issuance, so much expected issuance, and a change in the demand-supplied relationship in the back end of the curve may not go down. You remember the original Greenspan conundrum, right? This is the same kind called the new conundrum, where instead of Greenspan raising rates and the back end isn't going up, this is Powell cutting rates, but the back end isn't going down. So you got to be really careful. I like that front end. You can buy it with a little bit of spread in investment grade. High yield we like, but it's a yield play. The spreads are quite compressed. You talked about the economic outlook and the equity outlook. High yield benefits from that outlook as well. But it's priced in. The credit markets have always gotten this recession call right, meaning there is no recession. Spreads were the dog that didn't bark. They were a better signal on economic cycle indicators. And I still think that's a pretty good place to invest as well.
Talking about the short end of duration, cash. Everybody's talking about how much cash is out there. First of all, we have to remember part of that is institutional cash, this $6 trillion that people have been throwing around. Part of that's institutional cash. Part of that is retail cash. Clients are excited to have cash because they haven't had yield in 14 or 15 years. How does cash fit into the equation, or would you be deploying cash into assets right now?
So the first thing is I think cash is back, right? We talked about bonds are back, but cash is back as sort of like stocks, bonds, cash. We used to think about as asset allocation. And then for a long time at zero or negative real interest rates, you couldn't hold cash. So you can hold cash again, and it's a useful vehicle for liquidity and management purposes. But people have too much cash because they piled into cash after 2022, and they were rewarded for doing so. They've been rewarded as well this year for kind of staying in cash a bit. Depends on, fixed income versus equities, but fixed income ag performance is negative, so you're better off sitting in cash. I think the big difference will come about when the Fed starts cutting rates. It's kind of like that mortgage refinancing dynamic where people don't refinance as mortgage rates are declining because they expect that mortgage rates will continue to decline. And where do you see the biggest increases in mortgage refinances? After the interest rates have gone back up. So I think with money market rates, it's the same kind of behavioral dynamic where people are happy to stay in cash. They see the yields, they're consistent. And once you start to see the yields going down, then you'll start to see kind of the aha moment of, oh, these cash rates aren't going to be 5% forever. And if you look at what the Fed's projecting, it's 75 to 100 basis points lower by the end of this year. So if you like those yields and you want to keep them, you got to move out of cash, and you got to kind of start planning to do that now. You got a little bit more time because the Fed's not going to cut in March. But, over the next quarter, it's really about preparing your clients in the portfolios that, hey, if we like these level of yields, we've got to move out of cash. And as we just talked about, you can kind of protect it for a little bit by moving into the 2-year. If you want to protect it for a lot longer, that's what I meant by kind of the all-in yield levels of high yield are quite attractive. And that's a place to kind of lock in different levels of risk and different levels of equity risk. But you really got to move out the risk spectrum in fixed income. And I think you'll start to see people recognize that as the cash yields start to come down.
I think that's a really good point and a very, very helpful point. Another important component to the economy and to corporate profits is productivity. And there is a new buzzword called artificial intelligence, or AI. Personally, I think we're very similar to the mid-1990s, where we really started getting the benefit of computers coming into the business world. Just-in-time inventory, had taken hold. The internet started coming into play. And the markets from 95 to 2000, if you look at the charts, almost went vertical. People think the markets went vertical from 99 to 2000. No, it was from 95 to 2000. Now, I don't think we're 99 and 2000 yet. I think we're in this mid-1995-96 phase where we're just starting to take off. Greenspan talked about productivity, almost kind of, it looks like computers are adding, and TMT was the big slang, tech, media, and telecom. Looks like it's adding to productivity. I think the Fed was just learning how to analyze all this productivity enhancement. Now, jump ahead to where we are today, we have artificial intelligence. And it seems anybody that's in the know of artificial intelligence is saying it's going to impact every business, every person. And if you don't embrace it, you're not going to win. Where are you in AI? How are you using AI in your models already? Are you using AI to analyze anything? Are you finding that AI can add to productivity and corporate profits? So I asked you a lot of questions.
Yeah.
So basically what I'm asking, what are your thoughts on artificial intelligence?
So first of all, we are systematic investors. You said quantitative. So we've been doing AI before AI was cool and before it was like top hit on Google Trends. We were doing earlier versions of AI. AI is pattern recognition. And so pattern recognition, where you see kind of the first generation of this pattern recognition is machine learning. And you see it in like facial recognition, right? Facial recognition got really good really quickly. And so we started using those types of approaches 10 years ago. Not in terms of facial recognition, but in pattern recognition. And in an economic context, it's take lots of different economic indicators and market indicators and look at past periods of history and then compare them to current and look for similarities and use that systematically to identify and use it in the forecast of return. So we've been doing that for a very long time. What's another example of kind of the earlier version of AI? And then I'll talk about kind of these more modern versions. Natural language processing. So natural language processing is, let's see if a computer guided by human intuition can take a speech from a central banker and break that speech down and qualify that speech bullish or bearish, accommodative or hawkish. And the first versions of those models went into inputs into our process, which we call sentiment indicators. We can take earnings calls and earnings transcripts, and we can look at that natural language processing of those calls and get a sense of what's the sentiment coming off of.
And they can read them in seconds versus
and you can do it
minutes.
And the real advantage of systematic is not one at a time, but doing it in the cross-section across thousands of companies, doing it consistently at the same time with instant analysis. Okay, so that's kind of version 1.0, if you will, of AI. What we have found in the second version, the kind of chat GPT or the generative AI, these large language models in the language space for reading large reams of data, is it is a step function improvement in terms of the quality of the analysis of the sentiment that we can get from these models. The difference between kind of the first version and the second version using the generative AI is improvement in the accuracy of the assessment of the sentiment. The way in which we do that is we test it. Here's a human. We take a bunch of humans and we say, okay, you read those transcripts, you read that central bank communication, score it. And then we'll do that across 10 seasoned analysts. And then we'll have the models do it. And you compare the version 1 versus the generative AI, and it's an order of magnitude of an improvement. The most remarkable thing about the generative AI improvement, however, is that not only does it have the capability of giving you the sentiment, it can give you its rationale. It can tell you why it came up with that answer. And so you get two levels of sentiment analysis, not only the conclusion, but the factors that went into that conclusion. It's a remarkable step forward in terms of technology. And we're using it in our models today to kind of upgrade a lot of these earlier versions where we've been using AI and machine learning for over a decade, now using the more powerful tools of generative AI, large language models on text. And it's only the beginning. So in addition to how we implement AI in our investment process, obviously we're investors and AI is a huge investment theme. And so in addition to kind of the focus on NVIDIA, we've had a whole AI thematic investment around some of our systematic equity portfolios. And to kind of bring it back to full circle, we had this really interesting application of AI, which we call the thematic robot. And the thematic robot, what it does, you're very familiar, of course, with this concept of thematic baskets, right? So you have like an election theme or Trump trade or Brexit, you have kind of a theme and you build baskets related to equity exposures, long shorts that express that theme. So we've applied artificial intelligence to create the baskets in an automatic fashion. And it's a really remarkable application of AI, right? So basically you prompt it, and a lot of it is this so-called prompt engineering. But you sort of what companies are most exposed to, your theme. And a lot of it depends on how you do the prompts, but it basically goes through an incredible amount of data. So it looks at filings, it looks at transcripts, it looks at analyst reports, it looks at media reports to figure out company exposure to a particular theme, and it helps us to automatically create thematic baskets.
It would take an individual days to go through all of that, or teams of analysts.
Yeah.
How fast can your machines go through that data?
As fast as you can prompt it. And that's the
productivity enhancement.
And that's back to the macroeconomic question about it is like in the mid-90s, you're introducing new technology that's a step function in terms of productivity. We have got to figure out how to use it, and that's what the 90s were all about, and that's what this period is about. How do we use it? A lot of questions about its disruptive capability, but it's certainly showing, at least initially, incredible opportunities for productivity enhancement, and only scratching the surface because we're only talking about the large language models. The applications go beyond language. You can apply these techniques to lots of different types of data sets, not just language. And that's what we're going to hear a lot more about in the future.
So I am going to make an assumption that you think this is going to add productivity enhancements to companies' bottom line and to the economy.
I think so. I mean, I think, I'm a little bit of a bond skeptic, and, we tend to really, get super excited about these things. But these are the things. There are a few things. Go back in your history of your experience with technology. There are a few memorable moments. I remember people lining up for Windows 95. That was a big deal. I sometimes will remind my kids of that, and they're like, "What's Windows?" Right? And these things change. Or I remember the first time I went on Google search, right? We had Lycos and Excite, and they were terrible. And then you went on Google and you're like, wow, this thing is good. Remember the first time that I got an iPhone, oh, wow, this is amazing. And I remember the first time I put in a prompt into ChatGPT, and it was of those levels of impact. And when you think about the things that those levels of impact, I mean, that Windows 95 is that mid 90s productivity miracle that you're talking about. Google and the iPhone and all those changes. So I think we're talking about similar levels. Lots of people are talking about multiples of those things. I'm not sure that they're multiples of those things, but it is definitely a huge, huge impact.
Jeff, this has just been an incredible conversation with just amazing content that I think our viewers and our listeners are going to find very helpful. We've talked about many different things. Is there anything else that you'd like to talk about? Or have our listeners and viewers know?
Well, I think we covered a lot, and I covered the point that I wanted to cover about alpha and the importance of alpha investing, and that's really the distinguishing part. What is systematic? There's a lot about what systematic is in terms of how we do it, and I often push our team to say, our clients don't care about how we do it; they care about what it means to them. And what it means to them is what we extract as systematic investors is critically the ability to separate the beta, the directionality of markets. You can get a lot of directional exposure through lots of different vehicles, but generating pure alpha is our real competitive edge, and putting that into funds like the funds that I run is really the additive piece in why you care. When you take a look at it and you see it in practice, alpha is very important and very additive to a portfolio.
Jeff, this has just been an incredible conversation with amazing content.
Thank you.
Thank you, dear friend.
Thank you
for being here. And thank you for joining us.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisory services offered through Sanctuary Advisors, LLC, an SEC-registered investment advisor. Sanctuary Securities, Inc. and Sanctuary Advisors, LLC are wholly owned subsidiaries of Sanctuary Wealth Group, LLC.